Hi, everyone. Thank you for joining us for today's Q2 2024 Mortgage Trend Series. Today, we have a special guest featuring Justin Wiseman from the MBA. So with that, I'm going to turn it over to today's host, Seth Sprague.
Great. Thanks, Gabby. And welcome to the Q2 webinar trend series. We're trying a little bit of different format this time. We're going to present some of the same data that you've seen from our data analytics team led by Tyler House. But we're also going to try to incorporate in with Justin a lot of the current trends in the marketplace when it comes to regulatory changes. So it's going to be a little bit of back and forth, and then we're going to weave Mignonne here at the end. But as just some housekeeping items, there are some CPE credits available. You do have to answer all 4 of the questions to get that. This session is being recorded, so we will get you out a recording in the presentation deck, usually a couple of days afterwards. And all participants are on mute, but feel free to mute yourself or write in the Q&A section, submit those questions, and we'll try to get those answered at the end. We're going to try to leave about 5 to 10 minutes as we usually do for Q&A. And there will be a quick survey at the end of this webinar as well for feedback. Like, we want more Justin and less Seth would be a great comment. I keep pushing for more Justin and less Seth on these webinars. For those that don't know us, Richie May, about 40 years in the industry, dedicated to the mortgage banking industry. We try to understand our markets as best we can, and this is one of the quarterly deliverables for our folks. We're very much focused on mortgage banking across the entire firm, though we do participate in some other segments of the market, particularly their cybersecurity offerings as well, and internal audit offerings. Quick agenda today, we're going to kind of talk about some regulatory and issues going on in the industry, show you some data, and then there'll be Q&A. But without further ado, let me quickly introduce everyone on the panel. We've got Justin Wiseman, who is the Vice President at the MBA of the Residential Policy and Managing Regulatory Counsel. Justin is a fabulous speaker, wealth of knowledge. I would encourage everybody to try to stump Justin in the Q&A section. Stumping me is really easy. Try to stump Justin, that's hard to do. I am Seth Sprague. I'm Director of Mortgage Consulting Services here at Richie May. Been here about 2 years. I'm joined by my co-partner in a wall here, Tyler House. So he can bang on the wall if he wants to. He's just recently rejoined the firm, but he is a director of our data analytics group. So all the data that we'll be presenting from Richie May Select is coming from Tyler and his team. And finally, and not least by any means, we're joined by Mignonne Davis. She is a director of our risk and compliance area, where she does a lot of internal audit work and our subservicing oversight. And as we talk about a couple issues today, we're going to get Mignonne's thoughts around that. So that's our general housekeeping. We're going to dive right in here. But again, remember, for CPE credits, you got to answer all 4 of these poll questions. So the first one is here. So Gabby, if you could bring up the poll question. The poll is now open, and I'm going to move this to see the question. But so this is a quick question, but as you're sort of driving around your neighborhoods, maybe going to work, maybe just going to the grocery store, or maybe just going to the movies, are you seeing a lot of for sale signs around? You know, the 4 answers are yes, more than last year, same as last year, less than last year, and for sale signs, there are none. So we'll give folks a few minutes here, a few seconds here to answer the question. Remember, you've got to answer all 4 of these to get your CPE credits. And this is just a quick poll to see what you're seeing in your neighborhood as you drive around town, around for sale signs, because the first thing, just to preview where we're going, is we're going to talk a little bit about the NAR settlement and its impact. But Gabby, let us know when we get to about critical mass and we can publish those results.
Both are in, so I'm going to go ahead and close this out. Looking at those results, a lot of us are seeing more or about the same.
So that's good. So that is a sign of the activity that's going on in the marketplace. Tyler's going to touch about that here when we get to some of the data, but let's start with Justin here and on the NAR settlement. So Justin, Obviously, this is one of the big headlines out there. It's pretty much can't have a conversation at MBA secondary without somebody wanting to talk about the NAR settlement. What does it mean for the industry? What are we supposed to do about it? Is this the end of the world for realtors? Am I never going to be able to show a house again? So with that as a preview, Justin, just riff on the NAR settlement a little bit and what does it mean and what should we be looking for?
Sure, no, absolutely. Although I have to say, Seth, after years of asking you hard questions and getting great answers back, I feel like this is the first time the roles have been reversed. So it's a lot of pressure on me.
It's a lot of pressure on you.
So that said, I think it's important to kind of talk about what the NAR settlement didn't do, because there's a lot of misrepresentation around it, right? And what the NAR settlement did not do is ban the practice of cooperative commission, which is where the seller essentially pays the buyer's broker, and it was previously disclosed on the MLS as a commission split, right? 2.5, 2.5, something like that. So brokers could go to the MLS, look and see that I, as a buy-side broker, would get 2.5% from the seller's agent if I, got my client to buy this house. What the settlement does is change how those offers of cooperative compensation can be communicated. No longer can they be communicated on a multiple listing service owned by NAR and likely any of the independent MLSs, and they can't be communicated through workarounds, right? So you can't pull an MLS feed into something that's basically like another MLS, but not in name, to get around the restriction of advertising cooperative commission on the multiple listing services. So that does not ban the practice of cooperative commission, right? It just requires an extra step. The settlement makes clear that brokerages can disclose on their website, as long as, again, it's not an evasion of the MLS prohibition, but they can disclose on their website and say, hey, I've got this listing for sale, seller, willing to pay 2.5% commission. You're also allowed to offer general concessions on the MLS. Now, those general concessions on an MLS can't say something specific about commission or be contingent on commission. So from the seller's side, it's how their agent communicates the cooperative commission that has changed most dramatically from the settlement. Now, from the buyer's side, something else has changed somewhat dramatically, very dramatically, depending on the state in which you live, and that is the requirement for a buyer-agent agreement for all MLS registered agents, which is most realtors. What that agreement will require is an objective, ascertainable number, so $5,000, 1% of the sales price, that a buyer and agent agree what the buyer's agent will be paid ahead of time, and that compensation cannot increase, and it cannot be contingent on what a seller would want to pay. So by way of easy example, in an arrangement that would not pass muster with the settlement is, you agree to pay me whatever the seller says he'll pay me. That would not work, right? It has to be an ascertainable amount, and it also can't increase. So if you agree to pay 1%, and for whatever reason the seller for the house you want to buy is offering 2.5%, your agreement controls, your agent gets the 1%. There's a few other disclosure obligations around that on both the sell side and the buy side. They have to reiterate, and this has always been true, but they have to disclose and reiterate that real estate commissions are not set by law, that they're fully negotiable. And then on the seller concession side, the sales agent needs written authorization to provide those concessions ahead of time. So where you're likely to see the biggest changes is now, before they even see a home, a buyer in theory needs to sign an agent agreement with the realtor. What you're seeing is some, that's kind of early in the process, right? So you're seeing some workarounds already. There's some showing agreements that essentially are one-off, specific services. I will be your agent, in quotes, to show you this house for no money, but that's the end of our arrangement after that. And we anticipate other arrangements happening as well. So that, at a high level, is kind of what the settlement does. It requires more disclosures. It makes clear that you cannot advertise cooperative commission on an MLS. And it also says that if you are a buy-side agent, you need to get an agreement from your borrower as to your compensation in a defined and ascertainable way.
And that buy-side thing is definitely unique to this. Now, Justin, kind of put you on the spot further because I never get to put you on the hot seat.
Exactly.
You put me always on the hot seat when you ask me a question in a public setting. When it comes to that, where are we sort of with the acceptance of this? We've seen a lot of headlines, right? This realtor is settled, this realtor group is settled, this realtor group settled. When we see that settlement, is that done? Is that Is somebody else still have to accept this agreement going forward? Is there still things that could change? Can DOJ come back? Like, does this end it, or can there be more sort of things in the future that we have that the realtor group needs to be aware of?
So like the axiom, nothing in American life ever ends, right? It all sort of just like goes on and on and on. But we are at an inflection point here for this, right? So when the settlement was first entered into, it's important to understand that it covered NAR, all of their members, all of their sort of owned or affiliated MLSs, and all brokerages with under $2 billion in transaction volume. So the sort of cascade of settlements you've seen since this, let's call it the big settlement, has been largely the brokerages over $2 billion reaching their own independent settlements with the settlement with the plaintiff's attorneys, largely along the same lines as the NAR settlement, but for less money than it would have cost them to opt into the NAR settlement, which had that construct. So that's kind of the swirl we're seeing. It's not new claims, it's sort of the resolution of kind of the old claims. The settlement does need to be approved by Judge Boo in Missouri. I think all of the smart money is that it will be approved. He's sort of given a preliminary green light for it to go ahead, which means that by August 17th, which is when the class notices get sent out, that's kind of the target date for all of the practice changes I described to happen. So August 17th is a very relevant date, but final settlement approval wouldn't occur until the fall. As to DOJ, that's an open question. I won't bore people with the long, I think it's at this point a 40-year history of DOJ's tangling with the realtors, but suffice it to say they have some reservations about the settlement. DOJ's position has always been they don't like the disclosure of cooperative commission anywhere because they think it creates incentives for steering on the realtor side. Like, I won't show this person that house because I won't make as much money as if I show them the other house. So they've sort of stuck to that position, but I don't know that that would be enough for them to formally object to the settlement. And then I think the smart money is, even if they were to object, the judge is unlikely to overturn the settlement. So the open and kind of unknowable question about this going on is, will DOJ at some later point kind of continue this crusade? And I don't know. And I think that's obviously heavily dependent on the election and what happens in November.
Yeah, I think that's going to be a common theme today. It's heavily dependent on the election, but that's a great background on that settlement. And yes, it's going to change things. It's in flight, like a lot of things in the mortgage industry. And so, Tyler, I'm going to come to you. Obviously, origination margins, origination volumes is a huge topic, a huge issue out there. So kind of where are we sort of with the trend series on kind of the volumes and what we see from our Q1 data?
Yeah, so the first quarter in a typical purchase market is down 10 to 15% versus Q4. And so the good news is that we're seeing quarter over quarter volume trends from our peer group be basically flat at like a minus 1% volume. Units are down 5%, but we're still beating that seasonal benchmark for Q1, so that's good. In part, rate decreases at the end of 2023 no doubt contributed, to this trend or to the favorable trend here. We saw a small uptick in refinance volume of about 12% sequentially, and this took our refi mix from 10% in Q4 to just 11.5. So, small change, but even, with that 12% increase quarter over quarter, if you take those refinances out of the picture, purchases still perform better than your typical seasonal trends. So that's positive. And then if you compare Q1 of 24 to Q1 of 23, volumes up 5%, and units are basically flat. So, again, we're seeing some positive trends. They're moderately positive, but nonetheless positive. And I think that's a major theme from Q1, not only in production, but also in margin, costs, and the productivity numbers.
I think that's a general theme that we heard from the MBA secondary last week, was slightly stronger Q1. So I obviously know what the next slide is, but what's the quick preview here on Q2 and what does that trend look like?
Yeah, so in these charts, we're looking at, 2023 in the green versus 2024. We've got apps on the left and locks on the right. And so apart from a spike in March last year, 2024 has actually tracked so far very similar to 2023. April fundings were basically right on top of each other in each of those years. And year to date, 24 funded units, they're 2% down on a volume perspective, 2% up 2% down on a units perspective and 2% up on a volume perspective. So very close. I think the good news as we look into Q2 or the early months of Q2 for application and lock volume is that April and May are trending ahead of last year. It does seem like kind of the seasonal pickup was shifted a little bit later in the year. So I would expect that Q2 fundings is probably a little bit behind what we saw last year, but I think some of that will carry over into Q3 and we'll probably have a stronger Q3 in terms of funded volume.
And I think most people would say that the purchase season or the traditional purchase season in 2023 was pretty disappointing of a seasonality bump. So sounds like maybe it's just a little bit later this year, but we're actually seeing a little bit more sort of a traditional seasonality, which sort of is suggestive of the poll question we asked. People are seeing a little bit more for sale signs, it sounds like, which sort of means a little bit more activity out there in the marketplace.
Yeah.
All right, so Justin, back to you, because I mean you're our victim. I mean you're our special guest today, so we appreciate you being here and appreciate the MBA giving us the time with you. So it doesn't seem like when I got into the mortgage space that Supreme Court rulings would be something that I would actually understand, that there was a login for it, and that every Tuesday like they issued things at like 10 a.m. Like the fact that I kind of almost know what's going on is kind of scary, in the sense that I actually know what's going on a little bit. So there's a couple of Supreme Court cases that we kind of wanted to talk through with you. And obviously the first one has something to do with everyone's favorite four letters in the alphabet, which is the CFPB. So can you just give everyone a quick update in case they missed the opinion of the court on the CFPB?
Yeah, no, absolutely. And I think to not bury the lead, kind of the news here is from the mortgage industry perspective, disaster averted, right? We may not like the CFPB, but we've really come to rely on the rules that were promulgated in the wake of Dodd-Frank to interpret that statute. So we have been monitoring this carefully to see and hopefully avoid any potential disruption to that regulatory ecosystem. For folks who have not been following it closely, which given how obsessively we've been tracking it is hard for me to believe, but I'm sure there are people out there who have not had the pleasure. This case concerned how the CFPB is funded. During Dodd-Frank, when the CFPB was created, they put in certain mechanisms to, in their view, protect it from undue congressional interference. And one of those mechanisms was that the CFPB is funded through a draw on the Federal Reserve, essentially. They are not funded by yearly appropriations like HUD and other agencies where you have the haggling over how much money they get this year. Congress can defund certain activities, and there's a lot more congressional accountability. So the CFPB was created expressly to kind of avoid that yearly process. Well, a challenge was raised in the Fifth Circuit, which is one of the judicial circuits here, located in the South, Texas and Louisiana, Mississippi. And in the Fifth Circuit, one of the arguments that was raised against the CFPB in an attempt to stop the payday lending rule was that this scheme, removed from congressional oversight to a large degree, was unconstitutional. It had violated the appropriations clause of the Constitution. And the Supreme Court heard the case on appeal from the Fifth Circuit and concluded no, that the appropriations clause of the Constitution does require that Congress appropriate a specific amount of money or appropriate money from a specific place, but nowhere in that appropriations clause. And they did a lot of sort of back and forth on the history of the meaning of appropriations in medieval England and beyond, which is what you get from the Supreme Court these days. But they did a lot of history, and essentially the takeaway is they did not find that appropriation sort of meant the kind of hands-on yearly appropriation or congressional control that I described as the case with other agencies. So the Bureau lives on. They continue to get their draw from the Federal Reserve, and all of the rules that were promulgated are now probably not vulnerable to this challenge. Because keep in mind, the same theory that would have invalidated the payday rule, that this rule was promulgated, written, and sort of created using unconstitutional funds, would have applied to pretty much every rule the Bureau had created since its inception, since that was the funding mechanism at its inception. So we were gratified to see the outcome that we advocated for in our amicus brief in this case. We did not take a position on the constitutionality of the appropriations mechanism, but we did say if the Supreme Court were to find them to be unconstitutional, they should avoid undue disruption by kind of according what the legal term is de facto validity to everything the Bureau had done prior to them being found unconstitutional.
And while one may argue that the CFPB may be disruptive at times to our industry, a lot of times it's going after some other group like payday lenders or something else. And in this case, mortgage would have been swept into that. And in full disclosure, if the CFPB had been declared unconstitutional, we would not have your pleasure on this call today because we'd be trying to figure out the legalese of the mortgages we've done over the last 13 years.
Yeah, correct. I mean, there's all sorts of complications that would have come to pass. You know, how the rules could be challenged would be different given when they were promulgated, the statute of limitations and things like that. But just imagine what the world would be like if the QM APR APOR tests were suddenly vaporized and everybody had to go back to statutory, ATR to figure out sort of where they were and whether these loans were compliant, consignee liability. It would have been, the technical term is a complete mess, and I think I would agree with that.
So we've avoided that. So that's, I mean, as we may or may not be a big fan of the CFPB always, having that consistency of rulemaking for mortgage banking is good going forward. That doesn't cause disruption, probably, that we have to worry about going forward. There's another case out there that I'm actually, not that I wasn't interested in the CFPB case, but I kind of figured out where that one might land, given other rulings. But there's another case out there that, again, we've got a lot of IMBs as customers here. And so this is going to be a bank rule, but I'm going to tie it back into the overall mortgage ecosystem here in a second. But there's a case out there, it's Zotero versus Bank of America, and it has to do with interest on escrows, right? So a federally or nationally chartered bank may take an exemption from a state rule, such as interest on escrow, and say, hey, that rule doesn't apply to us because we're taking a federal national exemption from it. That's a state rule, doesn't apply to us. And so there's actually a court case, believe it or not, and everyone says servicing is so boring. We've gone all the way to Supreme Court now with interest on escrow, and can these banks that are nationally chartered take an exemption around interest on escrow? So we don't have a ruling on that one, but can you talk about some of like the tangential, like if this is a snowball as I see it sort of at the top of the mountain, if this gets pushed over and all of a sudden states get a lot more of kind of authority here, we're gonna come to Tyler after you talk about this, but could really have some impact on the mortgage space, can it, when it comes to cost to originate, compliance, and all those good things?
Yeah, so this is an interesting case where so much is going to depend on how the Supreme Court rules and how they write their ruling. Because you're right, this is a case about whether or not national banks are subject to state laws. And the answer to that is pretty clear, right? No, if they significantly interfere with kind of core banking powers. But what does significant interference mean? The banks have taken the position in the cases in both the Ninth and Second Circuit that paying these interest on escrows would be an interference with kind of their core banking and lending functions. In California, they lost, and in New York, they won. So the Supreme Court is going to decide the tie, as kind of they always do, and really define for us what bank preemption looks like and what the tests that should be applied. And you're right, if that test meaningfully changes, you could see more attempts to regulate banking through state law, or if that test is, tightened up significantly and kind of everything is deemed to be a banking power, you could see the states lose some of their authority over banks. And so that's an interesting one to watch, and we'll touch on the cost of servicing. And then the bonus case I'll throw in, and people can ask about it if you're a real Supreme Court fan. And the questions is, there is a fascinating case about the haddock fishing industry that could have transformational impacts for the mortgage industry. So if you care enough to ask, we will leave that one lingering.
I'm going to write down the haddock industry because I love fishing ships, so I want to know about that one. We just came out of New York and all the Irish pubs, so obviously fishing ships.
Exactly.
All right, so Tyler, I'm coming to you on cost to originate. So to try to tie this back in, and this is again a bank concept, but remember, IMB's going to be ruled by banks, the interplay of warehouse lending. So from our data set, again, what are we kind of seeing on the cost to originate side? And again, rules and regulations always come with costs. I know that's one of the common themes that the MBA is always pushing when we get these rules and regulations out there, is what's its cost to comply with. And so what are we seeing on the cost to originate sort of in our data set these days?
Yeah, we're continuing to see costs at an all-time high. If you look at this chart here, on the far right, we've got our Q1 2024 average cost at 13.5, or a little over $13,500 per funded loan, and so that's 3 consecutive quarter-over-quarter increase. And the most recent quarter-over-quarter increase is about $600 per funded loan. So, we continue to be challenged in this area, and I'm sure everyone would look forward to more challenges with the other stuff going on. But I'm actually pretty encouraged about the Q1 results. And if we take a look at the next slide, we can kind of dive into deeper why I'm actually encouraged by a $600 increase. And so the first thing we should note is that there are some seasonal factors that are driving Q1 costs to be a little bit higher than they would be normally. And first, that the first item is going to be annual discretionary bonuses. So often these bonuses hit Q1, and so you're going to see this impact across the board on all the different personnel functions, with even a larger increase on the corporate personnel. The second item is that payroll tax rates are typically higher because of Social Security and unemployment caps, which are usually hit later in the year. So that's part of the seasonal increase. And so, it may not be a full $600 increase quarter over quarter with some of those seasonal items driving it up. The other thing is that we've seen sales personnel increases. Where's that number? If you can see, it's about $174 per funded loan, quarter over quarter increase. That's entirely driven by higher loan sizes. So we're seeing about 4 to 5% higher loan amounts in 2024 versus last year. And so that's purely driven by that. If you're looking at this cost in basis points, you're actually maybe seeing a slight decrease quarter over quarter. And so again, that's one of those items that I'm not too worried about. The other real positive that I'm seeing here is it's going to be a decrease in operating costs. It's only $63 per loan, but I think it's the first time we've seen in several quarters that number move in the right direction. And so that's going to be the result of some of the work restructuring that a lot of companies did at the end of 2023, and they're starting to see some of that benefit. And again, this decrease comes also with 5% fewer units quarter over quarter. So I'm very encouraged by that. And we can also see a similar trend in funded units per employee. So we're seeing about a 3% improvement in loans per employee on a monthly basis that we can see at the bottom of this slide here. Again, it's kind of a modest improvement, but it's improvement. And again, it's with fewer units. So that's what's encouraging me, and hopefully we'll continue to see this or see some of these improvements, but see this total number decrease as we get further into the year.
Yeah, and as you've said on other calls, right, if we could just drive some more units through, this will help. And there's some one-timers or exceptional numbers here in the first quarter that aren't going to be in an annualized run rate. So that's great. And as you pointed out, operating costs are down. And there's been a lot of wood chopped, right, with the IMBs about reducing staff, outsourcing, et cetera, whatever we're doing in that space. So that is encouraging that at least there seems like there's a light at the end of the tunnel here. Volume's up a little bit more inventory, a little bit better cost control. So, I think we may have a poll question at some point, but it looks like the second half of the year might be better than the first half of the year. With that, let's go back to, we have our second poll question. And so what is your perspective on the 2024-20? What is your perspective, easy for me to butcher, the 2024 spring summer home buying season? Better than 2023, worse than 2023, or about the same as 2023? And remember, if you're on this call for the CPE credits, and not to make sure you answer all 4 of these. And again, we're just trying to take a little bit of a poll here of kind of a view as to where people are thinking. Obviously, the data that Tyler has presented sort of speaks to the fact that maybe this buying season started a little bit later, but it might be a little bit stronger than 2023. So that would actually be good for everyone's financial statements. And obviously, the units is a huge driver, as Tyler pointed out as well, right? We still have this unit issue, even though we're having more. The UPB looks one way, units are still sort of lagging. So, Gabby, have I tap danced long enough to get critical mass here to answer this one?
Give everyone just a couple more seconds. Again, please make sure you get those votes in if you're looking for CPE credit.
Or an autographed picture of Justin, which we'll sell in the lobby after the presentation today. All right, so what our poll results show?
50% saying better than 2023 and 40% about the same as 2023. Our smallest percentage at worse than 2023.
Tyler, it's always good when the poll questions sort of line up with the data. It makes you feel good,
Absolutely.
right? That's what we're seeing. That is not always the case when we're dealing with the mortgage industry. All right, so let's move on, Justin, to another one topic, and this is a topic I found fascinating. I haven't bought a house in a while, so this doesn't, I'm NA on this, but and for those that excuse me, didn't attend MBA advocacy in March. First off, the MBA did a great job. They had the cherry blossoms in full bloom for it. And second off, trigger leads was one of the main topics there. And it was amazing to hear the stories as we were talking to representatives, not only from the different companies as we were in our group, but from what the legislatures and the legislature aides of, they all knew about trigger leads. This is something that has impacted almost every one of them in some way. They got a cousin that was getting a loan. They're helping their parents buy a house. They were buying a house. And trigger leads just came up as a topic that actually seemed to have universal, which is scary to say in DC, acceptance, regardless of their political stance. So Justin, where are we with trigger leads? And can you update us on some of the bills that are out there? And I know in our practice round, you actually mentioned two people. They're actually like agreeing on something, which never happen. So go ahead and tell us about what's going on with the trigger leads.
No, absolutely. And just so everyone's on the same page, to pull someone's credit and get their information, you need a permissible purpose, right? And one permissible purpose in the statute is to give them what's known as a pre-screened firm offer of credit, which is generally called a trigger lead, right? That when they have had their credit done as a hard pull for a mortgage, the lead will be sold to others who in theory would make them competitive pre-screened firm offers. That has not been the experience, particularly with the switch from sort of a mail-based regime, which may work better in card and other places. But in mortgage, it's generally resulted in a deluge of phone calls, some of which probably are legitimate, many of which are harassing solely due to the volume, and some of which are actively misleading, right? We've heard stories of people say, oh, hey, yeah, this is, Joe from your lender. Can you resend me those docs? Or, say other misrepresentations that are confusing and frankly fraudulent to consumers. So this is a real problem. And we were able to persuade, thanks to people like Seth, who joined us on the Hill for the National Advocacy Conference, that many people in Congress that this was a problem. And we were gratified, having done that persuasion, to see the introduction in the Senate of what we'll call the Reed-Haggerty bill, which would ban the sale of trigger leads related to residential mortgages, except in 4 instances. The first is if the consumer has authorized the trigger lead. The second is if the purchaser of the trigger lead originated the mortgage. The third would be if the purchaser of the lead is the current servicer. And then the last exemption or exception to the ban would be for those that have a deposit account for the borrower. This legislation was crafted in negotiation with Senate offices to address some of their concerns. And we were really heartened to see that we have 31 co-sponsors now, including, as Seth mentioned, Senators Warren and Tuberville, who I imagine do not agree on much. So the fact that they are on the same piece of legislation as co-sponsors suggests, I think, healthy bipartisan momentum. A little more work to be done in the House. Representatives Rose, a Republican from Tennessee, and Richie Torres, a Democrat from New York, have introduced the identical companion bill to the Senate bill. So it's the same exemptions I talked about, with the hopes that if one chamber is able to mark up and pass the bill through kind of regular order, it would be easy for the other chamber to pass it, and you wouldn't have to do sort of the reconciliation that can take a lot of time. I think we should be very happy with where we are, given starting kind of from zero on this issue. To have 2 bipartisan bills in both houses is a credit to NBA member advocacy. Where we're going to run into challenges is this is an election year. Floor time is incredibly scarce. In the House, for example, retiring Chairman McHenry has always been sort of focused on digital assets and crypto and would love to mark something up there. There hasn't been a housing markup in the Senate in a while. So we may have to pick this up next Congress, but it is definitely something where there's attention being focused on what we hope would be an appropriate solution. And this is where I put in a plug, right? If you're passionate about this issue, or you're passionate about preventing the harassment that is happening to your customers, you should reach out through the Mortgage Action Alliance at MBA or just on your own to your congressman or woman and tell them to either co-sponsor one of these bills if they're not already a co-sponsor, or if they are, thank them for co-sponsoring it and encourage them to encourage leadership to bring these bills to markups into the floor, because we think this is a solution to what is a very pressing and kind of annoying aspect of trying to get a mortgage in 2024.
And you'll be amazed if you do reach out to your representatives or senators, how they actually, once you explain what this is, they're like, oh, that happened to me, or that happened to someone on my staff, or that happened to my brother, or that happened to my, so it's very pervasive out there. And so obviously the NBA has done a lot of groundwork on this. Tyler, real quick from your standpoint, like I hear trigger leads, I hear like offering a credit, that's all costs, right? When you were showing some of that cost data, any thoughts on, I mean, it's particular business model is probably more impacted, but any thoughts there on the cost side? Is this more sand in the gears, or is this really, for most of the folks in our data set, kind of a non-event because it's really not sort of their core business to obviously be trying to monetize trigger leads?
Yeah, so, I think the main cost that, you're concerned about is that cost of credit. And we've seen, those costs increase pretty substantially for a lot of lenders. And, my question really is, I would assume this is a revenue stream for a lot of the credit bureaus to sell these triggers. Now, I don't know what portion of the triggers would be for those 4 exemptions versus, not those 4, but it does sound like, based on everyone's experience, that it might be a meaningful portion of revenue, at least from the triggers. And so if that's the case, I'm asking the question, are we going to continue to see increases in the cost of credit? And on top of that, I think with the CFPB looking at junk fees and credit report fees being kind of part of that scope, I think this is just another area where lenders really need to stay focused on managing their practices and processes for running credit. And you need to also monitor really closely your pull-through rates to really keep these costs from getting out of hand.
Gotcha. Great points, as always, Tyler, on that. All right, so we're going to do one more poll question before we talk about everyone's next favorite topic, which is VASP. So on the next poll question, and I'm going to try to read these as best I can, but what do you think about, and Gabby, I may need your help because it's kind of tough on my screen, but what do you think about mortgage profitability will look like in the second half of 2024? Answer A, second half will be stronger, i.e. more profitable than the first half. Answer B, we're going to be worse off in the second half. Or C, it's going to be about the same. It's going to be a push. The first half and the second half of 2024 are going to about the same. Now, there are no wrong answers here as we go for these CPE credits. Remember, you got to answer all 4 of these questions to get it. But based on the data that obviously Tyler has pointed to, and is supported by some of the earlier polling questions, I'm leaning towards most people for hopefully answering A here. Obviously, Mike Frantoni and the MBA have a rate forecast. I know they've updated it recently, but they are saying for at least a softening of rates in the second half of 2024. So hopefully, Gabby, I've filled enough dead airtime that people that want the CPE credits have answered this third question.
Getting really close. Going to reiterate one more time, if you want CPE, submit your answers now.
Otherwise, we cannot give you CPE credits, and you'll have to, I don't know, get them somewhere else.
You'll be sad, we'll be sad, everybody will be sad. All right, looks like we got those last few coming through, so we'll close this. And it looks like the majority are expecting to be more profitable in the back half of the year.
That's
so
good.
Hopefully we'll see expecting it to be about the same.
Well, hopefully we'll see more people at MBA Annual out here at the end of October. So, Justin, let's talk about another hot topic from New York last week. And my general answer always was VASP, never heard of it. Jenny May, never heard of it. I don't know, calls Justin at the MBA. Obviously, VASP is a program that's out there that is trying to be rolled out by the VA. It has to do with helping veterans. I think the whole industry is always in lockstep on trying to help veteran borrowers as best as we can. But can you talk a little bit about VASP at a high level, what it is, talk about what we were actually advocating for, in March, which actually was a VA partial claims process. And then I'm going to loop Mignonne in a little bit on the operation side and what she's seeing. So Justin, go ahead and give us kind of that elevator speech on VASP and maybe why we also would while we support VASP, also want to have them look at this partial claims process.
Sure. So I'll sort of take that question as like, why do we need VASP? And the answer is partially because we don't have a VA partial claims program, right? When you do forbearance in the FHA context, the borrower, and this is obviously extremely relevant during COVID when the CARES Act sort of provided blanket forbearances to anyone who needed it. In the GSE and FHA context, with a few differences, when you do a forbearance, you essentially do a deferral. So the loan is a second lien behind the first lien. It's non-interest bearing and it's recoverable at the end of the mortgage, which, let's be honest, very rarely happens. So more likely it's recoverable at refinance or payoff, right? And that is essentially in the FHA context known as a partial claim. You use some of the insurance funds, the servicer does, to essentially catch the borrower up from their forborne payments and put it at the back of the loan. VA allowed this during COVID, but subsequently stopped their partial claims program. They did so because of questions about cost, and we certainly can debate that, and happy to take any questions folks have on that. But the impact was that there was no real meaningful solution for veterans in kind of the donut hole, right? When they stopped the partial claim program, and I believe it was October of 22, to now, as rates ran up, there was no VA mod that would really work for veterans, and you couldn't use partial claim funds to do rate buy downs and things like that you could use them in other contexts. So enter the VA's solution to this problem, which is the Veteran Affairs Servicing Purchase Program, or VASP. What VASP will do at a high level, and I'll let Mignonne sort of get into the operational details, but what it will do as a high level is essentially act as a servicing purchase program, right? VA is going to buy these loans from servicers, and it's not completely clear the mechanics of the modification, but suffice it to say, they will buy these loans from servicers, and they will be modified either by the servicer and then sold to VA, or by VA's contractor to a 2.5% rate. And that will obviously create, hopefully, significant payment savings for a lot of veterans that wouldn't otherwise be able to get that, because that's not a rate that most servicers would be able to modify to, and then the redelivery would obviously be awful. So that would not be an economic modification for most servicers. The VA VASP program is theoretically going live on May 31st. I don't think I'm being controversial to say that there are a lot of open and unanswered questions, particularly around the mechanics of the servicing transfers, that need to be answered before VASP is fully effectuated. So there's going to be kind of two challenges: the compliance and operation challenges that we're going to discuss in a second, but also the communication challenges, right? I think there is this widespread belief that come June 1st, if you're a veteran, you can call your servicer and get VASP. That's probably not going to be the case for most veterans. That's not because servicers don't want to offer it. They certainly do, and everyone's working as hard and fast as possible to stand VASP up, including the folks at the VA. It's just a relatively, well, I won't say a new program. It is a dramatic and almost transformational expansion of a very small to date VA program to accommodate this many loans. And it's going to take a lot of effort and understanding to get us there. And before we go to the operations, oh, by the way, we still need a partial claim. There, that's the elevator speech.
And Mignonne, there's so much of this airplane that's still being built on VASP. Can you talk a little bit about, just sort of from a subservicing oversight function or somebody who's got servicing, just a different part of the claims process, and to lead the witness a little bit further, how painful that is when it comes to either the forbearance process or the conveyance process, I should say more specifically, and some of the work that you do to help our clients that are at subservicers or servicing in-house sort of just navigate these messy waters of, let's just say, generically loss mitigation strategies?
Yeah, absolutely. Claims are always complicated, and there's a lot of different moving parts with claims. HUD, Fannie, Freddie, all the agencies and government entities have their different requirements and rules around servicing and then claims as well, right? And you can make mistakes along the way in servicing, which will result in a curtailed claim down the line. So there's a lot of different things with servicing that really impact the amount of money that servicers are able to recover on these claims processes. So you know, some of the things that that we help clients with is doing that loan level testing on the servicing side to help try to identify if there's delays during the process, like a foreclosure or different other milestones within the process there, lost MIT even, which will help identify some of those issues before, you know, it gets to become an issue in the claims process. We can also test the actual claims process itself on a loan level to see if, you know, if there's a reason why some claims are being curtailed, or, you know, it's really important because those curtailed claims are going to impact your financials. Those are losses that are no longer going to be recoverable, and a lot of them are preventable. So being able to do that testing and stay on top of that and correct errors that you're able to identify is really key. Really, we work with a lot of servicers and sub-servicers, you know, just making sure that their processes are tight and help with that oversight, making sure that they have good policies and procedures, you know, all of that, all of the main things that you would expect to see. But in addition to that, doing that loan level testing where you're really going to see where the rubber meets the road, so to speak, right? So that loan level testing is key. You know, and then just talking about VASP, there's, you know, FHA released a new supplemental payment, and then the VASP. So we've got two new options out there for borrowers there, and both of those come with a lot of different requirements and a lot of moving parts. One interesting thing that I wanted to note here is that the traditional VA purchase program primarily was handled by the VA technicians. They would evaluate the borrower, they would open the process in Valerie, do the mod docs, all of that. And from what it appears at this point, now it appears that VASP is going to put the onus and the responsibility on the servicers, where they are running through that new waterfall, evaluating the borrower, going through the whole process, opening it up in Valerie, and even potentially, you know, having the borrower execute the mod and going through that mod process. So a lot of different pieces now are going to be the responsibility of the servicer. So servicers are working really hard to stand up those processes, get those policies and procedures in order, and figure out how they're going to adhere to all of these new requirements that are coming down the line, right? And from an oversight perspective, if you're using a sub-servicer, you definitely want to be having those conversations with the sub-servicer to see what are they doing to get ready for this. Do they feel like they're going to be ready by the implementation date of October 1st for VASP? That's not very far. It's a very tight deadline. So I know they're scrambling, but trying to have that open communication and working with your sub-servicer to understand what they're doing to get in front of this, I think is essential and part of your oversight responsibilities. And I think it's also part of your oversight responsibilities to go in there and do some testing around their servicing processes, as well as their claims process, to make sure that they're doing everything that they're supposed to be doing in order to get that maximum amount of claim funds that are available.
And as Tyler's data already suggests, right, layering in all this cost, layering all this complexity around a new program, standing it up, that's cost. We're struggling on the origination side. So it's going to be an interesting how we weave this through. My advice is stay current with the MBA Loan Administration Committee. They're doing a lot of work on VASP. There's a lot of headlines out. There's almost a new issue of it every day of what's going on. So I'd strongly encourage you to stay in tune with the Loan Administration Committee with the MBA as you work through it. And obviously, Mignonne can be a resource as well for those folks out there. Great, Mignonne. Thanks for that. We've got one more poll question here before we go and have a couple kind of a lightning round with Justin here. But our last poll question, I remembered 3 of the 4. I really don't remember. Oh yeah, we were just talking really quickly about what your servicing portfolio might look like. And remember, for CPE credits, you got to get all 4 of these answers in. This is your last one. How would you describe your servicing portfolio? I don't have a servicing portfolio. I'm over 50% government servicing, or I'm under 50% government servicing. And again, as Mignonne and her team do sub-servicing oversight, obviously there's a lot more focus always on the government side of servicing. As she pointed out, you know, one misstep in a claims process can really truncate your losses. And as Tyler's data has suggested, you know, we're sort of struggling with the origination side. So, you know, we want to, you know, reduce risk, maximize revenue, and reduce costs where we can. So we'll give Gabby, everyone, another couple seconds here to answer this one, and then we're going to talk about one more topic, and then we'll open it up for Q&A. Gab, how are we doing with our responses?
This whole question. Right, we're going to close this one out. Like we have most people sitting at under 50% government servicing, but quite a few without.
Which is, I think, pretty typical for our client base through the data set. All right, this one's gonna be a little bit more of a lightning round for us, Justin, because we want to leave a couple minutes here for Q&A. But outside of VASP, which I did again at New York at MBA secondary, I declined all knowledge of, never heard of it. Freddie Mac's seconds program was probably the next most talked about topic. So again, Freddie Mac has come out, and it appears that it's within their charter to sort of be able to create second mortgages, and there's some restrictions around it. But again, it seems like this is, I could say this, you don't need to say it, but it starts to creep into a little bit of private capital. But what's kind of the MBA's thought process on the seconds program that's being proposed by Freddie Mac?
Yeah, no, I'd agree with you that it is within the scope of their charter to offer closed-end seconds. They've done it in the past, so I don't think this is like some unforeseen or dramatic departure from their authority. Our stance on the program is we'd love to get some more information on it. The new activities rule, and I think this is the first time it's been used, allows for public comment when the GSEs are proposing to do something like this. And then the FHFA director has a period of time to sort of say, no, you can't do it based on the comment. And our comment letter was largely composed of questions at this point. I think you're right. This does have some real potential benefits to help folks access equity who have very low first mortgage rates on their Freddie Mac loans. But what we don't know is a lot, right? We don't know if you're allowed to do these closed-end seconds on someone else's Freddie loan. I think we were told at secondary that is the case, but we haven't seen that in written confirmation. We don't know if you're subject to cash window caps, as some of the larger originators are, if this is also going to count toward the caps, because this is going to be a primarily cash window execution as they hold it on balance sheet to sort of figure out performance and securitization. And we don't know the pricing, right? You made the point that there is a nascent PLS market in this space for closed-end seconds. This could be additive, right? More liquidity could be helpful to the PLS market. But if Freddie's pricing through it dramatically, obviously this would be competitive and shrink the PLS market. So we don't know what that's going to look like either. And our call to FHFA is, while this has notional benefits, we definitely love to learn more about the questions I asked and the questions in our letter before we felt confident offering a full opinion on whether we think this is a good idea or it's sort of encroaching on something the private market could do well.
Yeah, I agree with all those points that the MBA put in their letter, and I just throw out from an MSR valuation perspective, right? A second typically is going to slow the first prepayment, right? To your point, it allows you to tap equity and keep that low first rate mortgage. So there could be some impact on MSR values, differentiating MSR values between if Fannie weren't to do this, if Freddie did it, right? I think that's a big if. I think they would do it. But it could certainly cause MSR values and for those loans to slow, or prepayment speeds to slow, potentially more MSR value or more MSR cash flows, or not somebody who's willing to pay for it. And again, if only one of them did it, it would affect the kind of the UMBS pricing, which is something that, again, I seem to remember the industry spent a lot of time trying to line up UMBS.
Yeah, I mean, I don't have any particular insight, so this is kind of a personal opinion, or maybe I'll ask as a question. Like, how do you maintain the UMBS if without Freddie or Fannie following Freddie's example?
My humble opinion, which is not worth the breath, is it starts to really cause that to be a problem. And we worked a lot in the industry to fix that. So we've got some key takeaways here, and I think we've got time for just one question. But and again, we want to thank everybody for their time. But our key takeaways are, it looks like Q1 2024 slightly better than Q1 2023. We still lag 2019 and 2018, which is kind of the last year. IMBs are really focusing in on their core competencies and kind of outsourcing the rest of that business, which can be accounting, which can be a variety of things, cyber, etc. The loss mitigation strategies, as we talked about, there's a lot going on. There's a lot in flight. Stay in tune with the Loan Administration Committee. It's an election year, so stay vigilant with the regulations and what gets passed. The regulatory environment is very fluid, and Justin stole our last one already, but join Ma. It's very important for you all to join Ma out there and be an active advocate for the industry. And I would strongly encourage people to attend advocacy if they can next spring. Justin, while we've got you, we do have one question. I think we could sneak this one in under wire if we do it as a lightning round. There was an FSOC report that came out, Financial Oversight Committee.
Stability Oversight Council.
Issued this massive report on May 10th. Very academic, very well written, I would say academic, but for folks that have read it or not read it, it required a lot of congressional action. MBA has come out with their position on it. Can you just kind of summarize kind of what the MBA is thinking about that paper? And
Sure. So at the very highest level, FSOC was created in the wake of the financial crisis to designate SIFIs, systemically important financial institutions, whose failure could have meaningfully bad impacts on the global financial system. So they evaluated sort of the risk of non-bank mortgage servicers through that lens and came up with a couple key conclusions. I think it's probably fair to say that they're okay with the capital and liquidity standards that have been proposed by the states, the so-called enhanced standards, because their recommendation was just more states adopt them, which of course makes sense, but they also point out that given the states that have adopted it and sort of the interstate nature of capital, 98% of the market is already covered by enhanced standards just due to the states that have already passed it. So you're right, the rest of it was kind of a punt to Congress to see who regulates these presumably well-capitalized entities, who supervises them. And there was also the proposal for a creation of kind of a bailout fund that IMBs would pay into, and then it would help for the bailouts of troubled IMBs. It's almost like deposit insurance without the benefit of the deposits, which strikes us as a little perverse and premature. So much to be seen. I think hopefully this is FSOC kind of concluding this work stream by having analyzed the problem and put forth their recommendations, a lot of which largely are dependent on congressional action.
Yeah, and I mean, we've got bipartisan support on trigger leads. We can't really move that together. We don't quite have bipartisan support on some of these issues. So probably it's definitely worth the read. I do agree it's kind of an academic paper. If people have further questions, you could submit them post, and hopefully they're all for Justin, and we'll get them over to Justin so he can answer them, all the tough questions. But I would really, Justin, again, thank you for your time. Thank you, the MBA, for all you do on the advocacy front for the industry. We really appreciate you taking the time today to be on our trend series. Great insight as always, and we're very happy we're able to loop in our data and our servicing expert Mignonne on some of these really salient sort of regulatory topics. So until we see you all next quarter, Justin, again, thank you very much for your time. Thank you and the MBA for all you do. And that concludes our presentation. There is a post survey, so please give us response back. We'd love to hear how this went for you all. But Justin, again, thank you very much. Tyler, thank you. Mignonne, thank you for your insights. And we'll chat with you all soon. Thanks, Gabby.
Great, thanks for having me.